So we've heard a lot from both Katie and Nico in terms of the growth of these markets, where they're growing. We've heard a lot about some of the market size and some of the specifics within the European Union emissions trading system, which is the largest environmental commodity market out there. What I'm hoping to do is provide one more example of one of these markets, which is the California and Quebec market, but also take a step back and think about it from the perspective of an investor. You know, what are you all doing here in this room? Obviously looking to invest your capital. So how do you look at these markets from the perspective of an investor? What are you actually buying? What are you actually selling? What are the characteristics of these markets? What are the risks of these markets? So the hope is to provide you with a lot of that context here today. Just a quick slide on environmental commodity partners. We are myself, my partner Alex Rao, who's here, and our third partner Blake Schaefer. We're based in San Francisco. We launched our first vehicle in January of 2018, and all of us have been involved in environmental commodity markets basically our entire careers, each of us for 14 plus years, and have transacted in a number of different markets across 6 continents over that time frame in a variety of different markets, a variety of different products. Our mission is to achieve uncorrelated returns for our investors in the environmental commodity space. It's fairly simple. A lot of folks have said to us, well, you know, are you impact investors? Are you green investors? We think that that's, in our view, a very nice byproduct. But our job is to return capital to our investors in an uncorrelated manner. So what are environmental commodities? Think of them as certificates. They're either certificates that are provided by a government, much like you would think of a permit, or they're certificates that are generated as a result of a clean energy project, whether it's a clean fuels project, or a clean electricity project, or a reduction of emissions from a particular project. You have 2 broad markets in the environmental commodity space that exist. You have what are known as the compliance markets, which are driven by regulation or by legislation, and then you also have the voluntary markets. We focus more on the compliance markets because from an investment standpoint, it's significantly easier for us to get our heads around supply and demand, as well as, to Nico's point, understanding the political, the regulatory, and the judicial risks and also facts that make up those markets. The voluntary space is also very interesting in that it's a lot more than folks at the retail level looking to offset, for example, their air travel or offset perhaps their transportation travel. You also are seeing a growing number of very large corporations that are entering into meaningful purchases of environmental commodities that are directly resulting in the growth of clean energy projects. So when you look at the traditional approaches to investing, what do we look at? Much like I'm sure most of you look at, event-driven opportunities exist in our markets. They exist in a number of different manners and a number of different ways. Perhaps the only slightly different way that we see event-driven opportunities in our markets is that very often you'll see, and it'll be telegraphed either in a public meeting from a regulator or perhaps some legislative event that's likely to happen, which will effectively set supply and demand or alter supply and demand. And very often those event-driven ideas or event-driven opportunities are what lead to a lot of investment opportunities for us. Supply and demand imbalances clearly is something that we take a look at. When you think about supply, generally the supply is made up of these certificates. When you think about the demand, it's generally made up of the emissions, the carbon emissions. In many of the markets that get created, a thoughtful regulator will typically try to avoid a situation where they try and create a price shock on day one, because of course, if a regulator starts a market on day one and they create an impossible target to achieve on day one, what's going to happen? Prices will go through the roof on day one. There will be a public outcry. Industry will say, you've made this target physically impossible to do, and then it's not going to work. It won't achieve the public policy goal. It won't achieve sort of anything for anyone. So thoughtful regulators typically will set the targets that they set, and they'll typically give industry time to determine how they're going to reduce their emissions or increase the renewable energy fuels or electricity. And then lastly, commodity finance. So in some environmental commodity markets, for example, renewable electricity, that's a great example of tremendous growth with a fairly plain vanilla business model. In the US, or at least in North America, a lot of the renewable electricity projects at a utility scale have been built off of the back of the long-term fixed price investment grade PPA, or power purchase agreement. That, combined with obviously a good engineering team and a good development team, is what has set North America well on its way to dramatic increases in renewable electricity. Renewable fuels is a slightly different story, or perhaps a very different story. Your typical fuels buyer, the refiners, they typically don't purchase their commodity exposure on a fixed price basis further out along the curve. They are more of a just-in-time type of buyer. So from our perspective as investors, this provides us with a lot of really interesting opportunities, because you've got a lot of these project owners, project developers that have capital, but limited capital, under which they want to develop and build their projects. But because there's traditionally been a lack of long-term offtake agreements to get their projects financed, that provides groups like ourselves with good opportunities, and other investors with good opportunities to partake in that marketplace. What are the risks in environmental markets? Everyone here should be very clear-eyed on what we're talking about. So while we are talking about commodity markets, these are certificates that can be changed, amended, or taken away with the stroke of a pen. So unlike traditional commodities like gold or coal or silver or what have you, where there's a physical need for these markets are created by definition, by regulation, or by legislation, which means that understanding the legal, the regulatory, and the political environment under which you're investing in is as important as supply and demand, if not more important than supply and demand. So we spend an inordinate amount of time ourselves on the legal, the regulatory, and the political basis before we look to invest in any of these markets. Rapid technology change, that is something else we look at, although that's not the one that keeps us awake at night. If you think about the energy business and if you think about clean fuels, change typically does not come overnight. Our view is that change likely will not come overnight. An example is the cars we drive. The average American purchases a new car every 7 years. And so while we expect, and I think most folks would expect, a significant adoption of electric vehicles or EVs in the coming years, we're not likely to see a scenario where 5 years from now, everybody's going to be driving an electric vehicle. There's a growing group of folks who are very informed that think 15 years from now, we might be in a situation where there's more electric vehicles on the road than internal combustion engines. So it's moving rapidly, but the time frame we're talking about here is not years 0 to 5, or perhaps not even years 0 to 8. Maybe it's years 10 to 15 or 10 to 20, but we're not talking 50 years out. So environmental commodities, these certificates, where do they transact? So unlike traditional commodities that will move back and forth in warehouses or on rail cars, these certificates generally will be moved back and forth between buyers' accounts and sellers' accounts in different registries. So think of that certificate as an individual serialized certificate that will be transferred from a seller's account into a buyer's account. How can you transact as an investor in these markets? You can either transact bilaterally with a counterparty, you can transact on futures exchanges, or you can transact at government auctions for those markets that do have government auctions. Those are generally the three ways that you transact, but all three of those ways generally will result in the transfer of these certificates into or out of your holding account, with the exception, of course, of futures markets. Another characteristics of environmental commodity markets is the lack of correlation. On the screen there, what we've highlighted are three of the larger, or the three largest cap and trade markets: the CCA market, which stands for California Carbon Allowance; the RGGI market, which is the Northeast Cap and Trade market, known as RGGI, Regional Greenhouse Gas Initiative; and the EUA market, which Nico talked about, the European Union Allowance market. You can see that there's a distinct lack of correlation, not only in the broader S&P and MSCI world equity markets, but also other commodities themselves, as evidenced by Henry Hub and WTI. This is an interesting slide in that these markets generally are structurally efficient. So why do we say that they're generally structurally efficient? If you look at this slide, you can see that the vast majority of the participants today that take place in these markets are the emitters, the refiners, the electric utilities, the cement companies, the food processors, all those folks who heavily outweigh the number of investors or the numbers of financials that participate in these markets. Why are there not a number of financials in these markets? We think a number of reasons. Number one, there is no such thing as one global carbon market. Katie and I don't know, Nico, if you were in Copenhagen in 2009, but we were in Copenhagen in 2009, and Alex was certainly there in 2009, and that was the gathering of all the world leaders, where at the time there was perhaps not an expectation, but certainly an almost expectation that there was going to be one global agreement, one gathering, and the world's leaders were going to come up with one big market. A week or two later, it was obvious that that was a complete pipe dream, and in retrospect, what makes a lot more sense to everyone in this market is countries, provinces, states, regions, they're going to do what they decide to do, what's best for them. And so reducing carbon emissions is a goal that, as Katie has stated, is very clear and unambiguous among the vast majority of the nations of the world. What's not clear is how do these different countries get there? And what has been emerging over the last 10 years quite clearly is that the growth of these markets are happening at a state level, at a regional level, at a provincial level, at a continental level. And the number of reductions in carbon emissions are all coming from these state regional programs, and that's what we expect to continue. Now, the reason why you don't have a lot of financials in these markets yet is because they're all very disaggregated, and they all have their own separate supply and demand, their own separate regulations. And so tasking one individual in your firms who have no experience in environmental commodities makes it incredibly difficult to invest or trade in these markets in a thoughtful way. And then you also have these markets that are perhaps frontier markets or relatively new markets. As Katie walked us through, 2007 wasn't that long ago when there was a small handful of markets. So this is still a relatively new space, although what I like to say is we're now in version 2.0 of these markets, whereas version 1.0 was back in 2004, 2005, 2006, whereas Nico has said we're all learning, including the regulators. And so again, when you look to invest in these markets, make sure that you're fully understanding which program, which regulator, which sort of market you're investing in. The idea of this slide is certainly not to go through all of these different points in time. The idea of this slide is to show that one market alone, the creation of one market alone, this market happens to be the California low carbon fuel standard market that requires a reduction in the carbon intensity of fuels, how long it takes to go from effectively inception to active transacting, where from an investor standpoint, we're very comfortable with getting involved in this market. So 2006 is really what started this market. A myriad of events, legal, political, regulatory, all occurred and got us to the point where finally in 2017, Alex, myself, and Blake became very comfortable investing in this first market. So the point there is these things take time, and they're constantly moving, they're constantly changing, but very rarely will you see a market all of a sudden being created out of thin air. One helpful slide we have here, or perhaps two helpful slides, is if you go back to just your basic economics 101, you have your traditional supply-demand curve where pricing meets at the intersection of supply and demand. That is not typically how our markets work. Our markets, you'll typically have inelastic supply. So on the supply side, you'll see a finite quantity of certificates. So think of a certificate in some of these markets as the right to pollute 1 ton of carbon emissions. Well, if the regulator is saying to a certain capped sector, let's say all of the big emitters in California, we are only letting you guys emit so many tons of carbon dioxide, that's the red line. You're not going over that red line. That's not going to happen. There are going to be civil and criminal penalties for those who go over that red line. So that's the definition of inelastic supply. On the demand side, you then have industry saying, okay, well, how do we reduce our emissions? As we're all fully aware in this market, change in a power plant or building a new power plant takes a couple of years. So there are often opportunities where you come up with inelastic supply with relatively inelastic demand, simply because of the time cycle to physically change the infrastructure, the energy infrastructure of the particular market we're talking about. From an investor standpoint, that makes for some extremely interesting pricing activity. We've talked a lot about the cap and trade markets, i.e. the carbon markets, but it's also extremely important to note there are numerous other environmental commodity markets out there, the transportation fuels markets being the one that's likely growing the fastest, not in terms of notional dollars because the EU ETS market's that one, but in terms of new programs. Why is the transportation fuels market growing so quickly? Because if you look at North America, for example, and certainly California, emissions are going down dramatically in the electricity space. Why is that? Part of it is because of the growth of renewable portfolio standards across the country. Part of it is because of the fracking revolution that made sort of natural gas much cheaper relative to coal. But the fuels markets continue to increase with respect to their emissions. So policymakers are looking specifically to tackle transportation fuels and how do you reduce emissions in that space. You also have regional markets that examples would be the Los Angeles Basin or in Houston, Galveston, that look to reduce particulate emissions, not just CO2, things like SOx and NOx at a regional level. And then you have other carbon assets that we can, or that investors can invest in, that in turn will generate environmental commodities. This is just a quick slide that shows the growth of the renewable portfolio standard policies that exist in the US. Today, you have 29 states plus DC that have some form of a requirement for their load-serving entities to have a certain percentage of renewable electricity and a growing percentage of renewable electricity. If we were having this conversation 10 years ago, you would be looking at less than half of that number. And so this speaks again to, if there's not a federal policy in place in many respects and in many markets, it doesn't really matter. What matters is what are the states doing and what are the regions doing. Going back to the fuels markets, California now has a vibrant low carbon fuel standard. Oregon has a low carbon fuel standard. The federal government has a renewable fuel standard, which for the most part has been corn-based ethanol, but there is a part of that renewable fuel standard that is tremendously helping biogas and other markets. The voluntary green gas buyers that we spoke about, there are many large investment grade corporations and universities that have entered into long-term offtake agreements that have resulted in the financing of many of these projects. So again, from an investor standpoint, that makes me feel pretty good. Meaning, well, if some of these regulatory programs change in a negative way, will the voluntary market still be there to act as a backstop? Maybe yes, maybe no. Our view is yes, but the point being, there's growth across all sectors here and demand across all sectors, not just in the compliance markets, but also in the voluntary markets. Canada is about to start its first year of its national clean fuel standard. I believe, is it in 2 years' time? 2022. And then the Northeast states planned, or at least they made an announcement at the end of last year, that they plan on moving forward with a fuels market as well. In addition, you've got several proposals out there, one of which is Washington State. So now I'll just dive into another example. Just like Nico gave an example of the European Union market, I'll jump into the California cap and trade market. So the California cap and trade market, it doesn't say this in this slide, but this effectively started back in 2006 when then Governor Schwarzenegger signed the first climate bill to reduce carbon emissions to a certain level, 1990 levels, by 2020. California ultimately decided, after numerous public stakeholder meetings, that cap and trade was going to be and is the most efficient mechanism for them as a way to reduce their carbon emissions and achieve the public policy goal. So right now, as a result of an additional law that was passed under Governor Brown, the law says that California has to achieve a 40% reduction in carbon emissions by the year 2030 off of 1990 levels. To convert that into plain English, California's emissions today are at about 1990 levels. So between today and 2030, emissions in California have to decrease by 40%. If you take a step back, 11 years from now, will emissions be 40% lower than they are today in California from a state that already has a tremendous amount of renewable electricity on the grid, a state that already has a tremendous amount of energy efficiency, and a state where more than 50% of the carbon emissions today come from the transportation sector. Everyday consumers just driving their cars and trucks. That's a big challenge. The cap and trade market is the single most important mechanism to help California achieve that requirement. There are approximately 500 facilities that are covered under the program. This program covers over 80% of California's emissions, so it's the broadest economy-wide cap and trade program in the world by percentage. The first auction was held in 2012. Quebec linked with California in 2014, and from an investment perspective, there's a very nice implied downside protection mechanism in this market, which is the quarterly auctions that occur each year have a minimum price, which informally is known as the floor price, which is required by statutory authority to increase at 5% per year plus CPI. So today, for example, in 2019, that minimum price is $15.62. By next year, it'll be 5% over that plus whatever CPI is. Just one last point there. This market is currently entering a period where the historic oversupply, which we'll talk about in a moment, is expected to slow and decline and reverse, drawing down any excess supply that exists in the coming years, and we're now just starting to see the expected price uplift in the markets as a result of that. So this slide, perhaps clearly demonstrates how a cap and trade market truly works. Going back to 2015, if you look at the gray bar graph on the left, That approximately 400 million ton number represents 400 million certificates that were issued that year. Those certificates, for the most part, are auctioned off each quarter. Some of those certificates are freely allocated or freely given to certain industries that are at risk of leaving California, which we could perhaps talk about more informally how that works. And some of that supply is actually held back by the regulator only to be reintroduced in the event prices escalate significantly to predetermined levels that are roughly 2.5 times where pricing is today. So as you can see, the cap in a cap and trade program really caps the number of certificates that are provided to the marketplace each year, and then that cap steadily declines. In California's case, that cap is declining at a rate of approximately 3.5% now. Later on, in about 5 or 6 years' time, that rate will start declining at about 5.5% per year. Now, that's supply. Demand is the emissions, the capped emissions of the capped sector in California, which, as we talked about, is 80% of California's economy. That green line over there is the most recently available data provided by the regulator, which is the reported emissions as of 2017. So you can see there that in 2021, according to this graph, there will be exactly, assuming static emissions and assuming static supply of allowances, which there will be, you can see that the market is exactly in balance there, purely by looking at that graph. You can see that in the years prior to 2021, there's this oversupply, i.e. more certificates available than needed given the emissions. And then you can see that starting in 2022, there's a fairly dramatic drop in supply relative to the demand. Of course, the emissions could go up or could go down. You have your views of that, but that supply is pretty static. Why, do you ask, are prices heading higher now when we still have this oversupply? And prices are heading now because you've got a couple of things going on. You've got an anticipation of that coming supply-demand imbalance, and more importantly than that, you have to know at a very micro level, where is that supply today? And who's holding on to that supply, and who's either looking to sell that supply or not sell that supply. So that surplus of excess supply may not actually be available excess supply, as opposed to just excess supply, if that makes sense. The pricing graph here goes back to January of 2014. As you can see, just to explain what this is, the orange straight line that steps up each year represents the annual minimum price or the annual floor price under which the regulator is willing to sell the allowances at the quarterly auction. The green line represents the prompt month ICE futures. And as you can see, for most of the time, this market has been tracking fairly close to the floor price in 2014, in 2015. In 2016, you actually saw the prompt month price transact in the secondary market slightly below the floor price. Back then, there was sufficient regulatory and sufficient political uncertainty to make a couple of folks nervous enough that they decided to sell below the floor price. In 2017, that regulatory and political uncertainty went away, and the market, as you can see, might have had a little bit of quick irrational exuberance by popping much higher relative to the supply and demand dynamic in 2017, before settling back down towards the floor level in early 2018. Now, in the last couple of months, we've started to see relatively strong increases in pricing, and we're now further along, April 16th, so just a couple of weeks ago, we're further along on the upside from that pricing perspective, and the question becomes, why? And that is likely because there's less of a concern now about any of the political or regulatory risks that existed prior to the middle of 2017. And now the market is focusing more on what is likely to be the actual cost of abatement, which we'll talk about in a minute. One other important point here is the money associated with these auctions. So these auctions that take place from California and Quebec regulators occur quarterly, as we've talked about. Thus far, California alone has raised over $10 billion in revenues for the state in these auctions, and that number is clearly set to increase as the pricing increases. Where does that money go? That money is going to, by law, climate change mitigation and climate change adaptation strategies as determined by the legislature. So there's something called the GGRF, which stands for the Greenhouse Gas Reduction Fund. The revenues from the auctions go into the GGRF, and they're used for a variety of different state projects. And these projects are effectively allocated by different members of the legislature into their different districts. So examples include retrofitting city buses to cleaner burning fuels like CNG or renewable diesel, CNG being compressed natural gas. Other examples include putting solar panels on either commercial rooftops, public schools, things of that nature. The point there, again, from an investor standpoint, is that this capital is significant. This capital is finding its way into various communities from their elected officials. And so from an investor standpoint, it just further in our minds solidifies not only that the regulator has chosen cap and trade as the primary mechanism to reduce emissions, but the capital flows are making it much stickier from a political perspective. Final slide is, what are we all trying to achieve here? What are these policymakers trying to achieve? Obviously, they're trying to achieve a reduction in carbon emissions or an increase in renewable fuels or renewable electricity. This is a Bloomberg New Energy Finance study that was done that talks about the actual cost of abatement. What does it cost to abate carbon emissions? And depending on the technology, depending on the strategy, the answer is it's all over the map. But from an investment perspective and the way we look at it, if you look at that green dashed line, that's roughly where current carbon prices are in California today. If you look at where the cost of abatement or the average or marginal cost of abatement is in meaningful volumes, that price is orders of magnitude higher than current market pricing today. So from that perspective, you would think pricing will continue to move towards the cost of abatement, because if you're senior management at the power plant or at industrials, you're going to say to your engineers, well, what's cheaper? Is it cheaper to invest capital into our units today? Is it cheaper to fuel switch today? Is it cheaper to come up with other mechanisms today? Or is it cheaper to buy these allowances? And hopefully, the power and the speed of the private markets will figure out ways to rapidly reduce that cost of abatement in the coming number of years, because that's the whole point, trying to merge policy with the power and the speed of the private markets to achieve the public policy goal. And perhaps to close the loop, Katie started off talking about the SO2 acid rain program back in the 1990s under the first George Bush administration. And I remember my first boss, telling me who was transacting in that market on many of the first deals, and was there as the legislation and the regulation was being formed. Industry was standing on the one side saying, this is never going to work. It's going to be way too expensive. This is a pipe dream. The environmentalists were standing on the other side saying, markets are bad. You should just shut down, these dirty coal-fired power plants and spring up a whole bunch of wind farms. And the middle ground really was a strong public policy that allowed the marketplace to do its thing. And the result was the SO2 program reduced SO2 allowances way faster and way cheaper than anyone thought. Now, that doesn't guarantee every environmental commodity market is going to work that way. In fact, clearly, as we know, they don't work that way. You have to have, very thoughtful policymakers at every level. You have to have accurate monitoring, reporting, and verification at every level. And as Nico had said, everyone's constantly learning. But we are clearly these days in version 2.0. These markets are clearly growing. Our view is they're clearly here to stay. And maybe with that, the presentation period's over, and we're happy to answer any questions.